Federal Drive is presented by GEHA, Government Employees Health Association, proudly providing health and dental benefits to federal employees and their families. Visit GEHA.com.
From fintech tools to new credit models, consumer finance has changed faster than the regulatory framework around it. Todd Zywicki says that gap is a central focus of the new Institute for Consumer Financial Choice at George Mason University, which is designed to bring more empirical research into consumer finance policy debates. Professor Zywicki joins me now. Professor Zywicki, it is great to have you on the show. Thank you for joining me.
Thanks, Terry. It's great to be with you.
Consumer finance protection, that's been a topic of interest over the last few months, certainly with the Trump administration, but even more broadly, going back quite a while. When you think about how consumer finance policy actually functions in practice, what part of this system is really under strain right now?
Well, it's a fascinating time to be doing all this. As we know, sort of the internet has exploded consumer finance. We see stable coins. We see more and more people investing in the stock market. We see all these different sorts of innovations in fintech and that sort of thing. And so we're really at sort of a historic point with the opportunities for consumers, for innovation, for competition, and more choice. But at the same time, that brings with it new threats to consumers, new products, new ways of people understanding things, and that sort of thing. And so we started this new center, the Institute for Consumer Financial Choice, me along with my co-founder and co-director Tom Miller, who's an economist, to update the laws, to study the laws, to understand what's going on with consumers, how consumers shop for products, and how to make the whole financial system work better for consumers.
Are those similar to the functions that the CFPB might have been performing if it had been fully operational?
It could be, yes. And as you know, the CFPB has been a bit of a political football since its beginning, and sort of trying to figure out sort of the extent to which it's going to promote innovation and choice versus protecting consumers. The more general challenge, I think, Terry, is our consumer financial regulatory system is really still premised on a logic from the 1970s and 80s, right? These long disclosures, all these papers. Just think about a mortgage closing, right? And that stack of documents you get. And what we see today is we're not using the same products we used back then. We don't consume information the same way we did things back then. And so what we really need is a system that can kind of spring forward, that the CFPB could be helpful with. Congress needs to be involved. And that's what we're trying to do, is kind of push forward and think about a new way of sort of getting beyond that 1970s model to a more modern age of consumer finance and financial protection.
The challenge that you're addressing here, the lack of speed and responsiveness in our regulatory system, crosses all kinds of sectors, but it may be most personally relevant here in finance when it's really difficult to figure out if stablecoin is reliable. Yeah. Should I buy gold bars? What's happening to inflation? Who knows? How do you imagine the center getting in the middle of all of that? What do you hope it is able to do?
Yeah, and you know, there's a lot of groups out there, existing groups that are sort of consumer protection groups, and you know, and they serve an obvious function for consumers, protecting consumers, educating consumers. But I don't think there's a lot of groups who are sort of taking the approach we are, which is a really comprehensive integration of economics, policy, law. My background, I've worked both at the Federal Trade Commission and the Consumer Financial Protection Bureau, so I've seen it from that perspective. I also have a graduate degree in economics. And so what we're trying to do is bring this integrated view of the world, which is how do we integrate economics with technology, with consumer protection, to give consumers more tools to navigate this incredibly complex, both complex but also exciting marketplace, where we now have more choices than ever before that, if handled well, can really make consumers' lives a lot better, but also create a lot of new pitfalls for consumers.
When you talk about this, the new options in the financial market, I mean, there are so many sources of information, reliable and unreliable, about all of these different kinds of tools and investment, it's the word I want, schemes, maybe.
Right.
How is a consumer supposed to make sense of all of this?
Yeah, it's very confusing. And, you know, we've also got to deal with debt collection and, you know, all the headaches around credit reporting, right? All these different sorts of things that people have. And that's really the challenge, right? Which is, in my view, the way the system is structured right now really isn't up to the task of a 21st century internet phone-based mechanism by which consumers are consuming information, making choices, and the like. And so kind of integrating, what we really want to do is integrate good primary research, right, economics, law, and policy, and then make that applicable, to kind of bridge that gap between academia and the real world, where you could take those ideas and make them actionable to actually improve consumers' lives through things like filing amicus briefs to inform courts, whether it's regulatory filings or just doing like the initial project that we're going to do next week on May 14 and 15, which is a big academic research symposium to talk about sort of important issues at the intersection of public policy and economics and law.
Todd Zywicki is George Mason University Foundation Professor of Law at the Antonin Scalia Law School. Todd, let's come back to the financial market for a minute. The fintech sector is way ahead in a lot of technological innovations, perhaps not always with the consumer's welfare at the center of that. We've seen a lot of conversation on the Hill about regulating cryptocurrency, and that gets tangled up in all kinds of things. And then within the executive branch, there are a number of federal agencies whose jurisdiction crosses here. How can the center help make what is a very complicated space a little simpler and clearer for people to participate in effectively?
Yeah, great question. Terry, it's interesting. In 2020, I was the chairman of a big task force that the CFPB put together, where we put together an 800-page report with 101 recommendations, basically on the future of the consumer financial system. And why I flagged that was what we saw during that period, of course, was COVID. And what we saw during that period, I always say, was about 10 years of innovation and technological development truncated into about 9 months of time, right? Where everything went online. All of a sudden, you got this explosion of alternative underwriting, because people didn't have to pay their bills, so the traditional FICO scores didn't operate. And so what we had was this huge amount of activity that kind of sprung forward. And since that time, we've kind of been trying to catch up, I think, with a lot of what's going on. In this, as you suggest, there's two obstacles. One is this regulatory fragmentation that you described, right? We've got a lot of financial regulators. The creation of the CFPB was obviously supposed to pull a lot of that together, but its current uncertain state obviously leaves a lot of that in flux. But the second thing is there's a lot of special interest jockeying around this, right? You've got the big banks who feel threatened by fintech startups and that sort of thing. You've got small banks that feel threatened by stable coins and fintech startups. You've got state regulators, you've got federal regulators. And what we're seeing now is a increasing divide between what's going on at the national level with the Trump administration and a lot of blue states that are becoming much more aggressive in sort of regulating consumer finance and kind of interfering in a lot of sort of interstate things. The final thing is the way in which the Supreme Court has changed its regulatory policies. I'm sure your listeners are familiar with, in terms of the deference that they give to regulatory agencies and that sort of thing. It's really cast a lot of uncertainty over this whole area, that we're kind of redoing a lot of things that it seemed like it had been settled law as we try to figure out our way forward in a world in which courts are going to be less deferential to regulators, where Congress is still kind of MIA. And so there's a lot of things going on right now, a lot of uncertainty, and a lot of potential for getting things wrong if we don't really understand what we're doing and why we're doing it.
We started this conversation talking about pretty esoteric investment vehicles, crypto and Bitcoin and some of those other things. But when I think back to the origin of the CFPB, we were talking about predatory lending, and individuals just basically trying to navigate day-to-day expenses. Not everybody is trying to figure out how much Bitcoin to buy. So where are the guardrails here around what is really relevant to the average consumer versus what kind of structures need to be built from a regulatory perspective for the broader finance industry?
Yeah, and that's always the challenge in a case like this, Terry, right? Which is that the growing proliferation of options, and fintech in particular is really good at this, right? Which is sort of personalized products, right? The ability to really get into fine-grained underwriting, to use different methods of looking at people's rental payments or utilities, rather than just looking at the traditional FICO score, which is a very crude one-size-fits-all measure. And so what we see now is this ability potentially to really create products that are really uniquely valuable to people. This is especially, I think, potential for traditionally under-included communities. A lot of the unintended consequences of Dodd-Frank and the like, of that sort of new regulatory overlay, was, I think, to create a lot of one-size-fits-all regulations to try to kind of protect people. But at the same time, it's had impacts like increasing the cost of bank accounts through Dodd-Frank, which affects minority and young consumers and that sort of thing. And so we saw a response. The response was fairly heavy-handed and sort of one size fits all. And I think, what we're seeing now is a clash between the efforts to try to create opportunities for consumers who don't fit in that bucket, younger people, minorities, that sort of thing. At the same time, we're trying to create this bulwark, this foundation that you described, of preventing something like the financial crisis from happening again.
When you think about the vision for the Institute for Consumer Financial Choice, what do you really hope to accomplish as you get it off the ground and running?
Yeah, great. Thank you for asking that. What we really want to do is integrate academic research and on how consumer markets work and how consumers make choices with policy relevant outcomes, whether it's in litigation or the like. And one of the things we've specifically tried to do with respect to this first program that we're doing next week is try to involve people from a variety of disciplines, economists, former government officials. We have the former deputy director for David Silberman, who was the deputy director of the CFPB when Richard Cordray was director. We want to make it bipartisan. We want to create sort of an environment where we get a lot of different perspectives. I think one of the big problems in the world today when it comes to this is we kind of have this binary in our head about consumer finance, which is deregulation versus more regulation, right? This binary. And I don't think that's right. Properly done, good regulation can be good for consumers, it can be good for industry and legitimate players, and it can be good for the economy. And so trying to figure out how we harness technology, how we harness the innovations that we see in the market to benefit consumers. This is really a bipartisan project, right? We all care about financial inclusion. We all care about making consumers, households more financially stable, capable, providing for good retirement savings and all these sorts of things. And so our goal and our plea is to help this maybe be a bipartisan project where people could come together and we could kind of think about how we improve the whole system, modernize the whole system to benefit consumers.
Todd Zywicki is George Mason University Foundation Professor of Law at the Antonin Scalia Law School. Professor Zywicki, thank you so much for joining me, and good luck as you get this important effort off the ground.
Thanks, Terry. And you can find us at Institute for Consumer Financial Choice. You can register for our conference next week, and we also have a live stream option if you can't make it in person. Thanks.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Subscribe to the Federal Drive wherever you get your podcasts.